Hello and welcome to Buy Africa, the show where we focus on investment opportunities around the continent. I'm Tshepho Modiba. Thanks for joining me. Tonight, I'm joined by Muyiwa Oni, banking analyst at Stanbic IBTC. Thank you for joining me.
Thank you for having me, Tshepho.
Let's talk, not beat around the bush. Let's talk banking in particular. Let's broadly speaking, what does the industry look like right now? What are the concerns? What are the positive lights popping up?
So the banking sector right now, there's a number of concerns. Asset quality seems to be a big one. So if you think about the volatility we've seen in the oil price, the type of exposure that the banking sector have had in that sector, that's become a big issue for Nigerian banks. So if you look at data, in 2010, banking exposure to the upstream oil and gas sector was close to about 0.5%.
Right.
Whereas at the end of last year was closer to about 10%, with a few banks having about 25% of their loan book exposed to the upstream oil and gas sector alone.
Right.
And so if you think about the type of, shall I say, errors banks could have made just accelerating loan growth into that sector, it's easy to see why they'll be concerned. So beyond just the sharp decline in oil prices, there's still concerns about management of some of those oil companies as well, and some other issues like security that has disrupted production in that sector. And so exposure to the upstream oil and gas sector is a key driver of asset quality concerns. Loans to power sector as well. So because there was a privatization of power assets around 2003, most of that were in foreign currency as well, and because we haven't seen strong progress in reforms in that sector, so there's been challenges with cash flow, and that's had negative impact on asset quality.
I guess the oil and gas sector, given the volatility that you've touched on, is an obvious one that would put strain. Any other sectors? I mean, the economy, broadly speaking, has taken a bit of a knock. Any other sectors that are squeezing the credit quality of the banks?
So trade is clearly a big one,
Right.
and because of so if you look at Nigeria, oil exports account for over close to 90% of government revenues, and for the country as a whole, over 70% of FX supply. And so if you think about the kind of the squeeze that we've seen or the decline in production, the sharp decline in prices that we've seen there as well, we've had issues with FX supply and FX liquidity, and so trade-related businesses, manufacturing companies that have to import raw materials have also had a squeeze as well. So if you look at banks' books, beyond just oil and gas sector driving asset quality deterioration, we're also seeing general commerce, which to a large extent there's a strong element of trade. They're also driving asset quality deterioration.
Will the relaxation of the currency assist with all of that?
So that should. But I would say it's clearly been a very slow progress. And as long as you continue to have difficulty with liquidity in that system, then businesses will struggle. And then I would say beyond that as well, if you look at the balance sheet of banks, particularly loan exposure, foreign currency loans account for, on average, about 45% of total loans for the banks. If we roll back 5 years as well, that ratio was closer to about 25% for the sector, and some banks as low as 10%. And so the dip in FX liquidity is also having a big challenge for banks' asset quality and ability for cash flows of customers to sustain that as well.
Naturally. Okay, let's you painted a fairly bleak outlook there. Let's drill down to individual companies. Let's start with the positive shoots. Anywhere that's looking positive from an operational perspective right now? So
for a few banks that have had, should I say, banks that have been lucky enough to have their balance sheets skewed more towards a net foreign currency position, they've been able to take advantage of the FX volatility.
Right.
So a bank like GTB, for example, if we look at their half-year numbers and 9 months numbers, they've had considerable amount of gains from foreign currency revaluation. And so with such banks, they're, in spite of the asset quality concerns, in spite of the material spike that we've seen in cost of risk and loan loss provisions in general, they're still able to sustain earnings growth. And a bank like Zenith Bank as well. I'll say overall, within our coverage, we see those two banks are banks that stand out with less concerns about capital adequacy, because of the, shall I say, dollarization of the balance sheet as well. We've seen banks come closer to the regulatory minimum of capital adequacy ratio, and those two still stand out as to be able to still absorb some of the shock, more because of the gains that they're making on the foreign currency side, and then overall stronger operating performance, stronger risk management processes for those two.
Do they have lower exposure to the energy, oil and gas sector?
So I'll say that's an interesting one. So if you look at GTB, for example, GTB has one of the highest exposures to the upstream oil and gas sector, interestingly.
So it's not an obvious answer that high exposure means a negative? Yeah,
for now, it doesn't look like, even though there's still clearly concerns to how that translates to higher asset quality deterioration. So like you say, it's not necessarily just a straight exposure means bad loans, because you obviously have to look at the operators and ability of management of those companies that you've extended loans to properly manage the business. But the reality is that it's also difficult to assume that the bank will still not take some hit on that sector, and more because there's still an overall macro concern in that sector as a whole, because of, one, lower oil prices, two, disruptions in production, and so ultimately I would expect it to still have some negative impact on cash flow. So what a number of the banks, or should I say most of the banks in the sector, have done is to restructure their oil and gas exposure, which meant to longer tenors, but obviously they've adjusted cash flows to help the business, to help the banks or the businesses meet interest payments. But ultimately we'll still wait to see how that performs, and if those obligors won't default on the new terms. But I'll say still a space out there we're still watching for now.
Given the reforms that you talk about that the banks are making with regards to assessing oil and gas credit, what does that mean for the oil and gas sector long term? Does that mean more expensive funding going forward, more stringent credit assessment criteria?
I would expect that. So for now, most of the banks we talked to haven't necessarily increased the exposure to the sector since 2015. More because of the challenges they're experiencing with the current exposure. And so a number of them have had to look offshore, look to private equity investors for support as well. So I'd expect that lending to that sector will continue to stay challenged as long as we continue to see low oil prices, if we continue to see disruptions in local production in that sector as well. So it's not a sector that I think banks are strongly willing to continue to support at a strong level at this point in time. It's clearly a sector that most Nigerian banks can stay away from, more because of the way the Nigerian economy is structured. But I would expect that banks would be a bit more conservative in their approach.
Okay, going back to the two that you like within the sector, do you like them in absolute terms? That is, are they sound investments to make as standalone, or is it really relative to the rest of the banking sector?
I would say it's a combination of the two. So if you look at a bank like GT Bank on a standalone, look at ratios like cost to income ratio, they clearly stand ahead of their peers. They've been able to manage costs well ahead of peers for up to over the last 10 years. And they look still clearly structured to be able to maintain that over the near term. ROEs as well, they've delivered the highest ROEs consistently in the sector for over the last seven plus years as well.
What's driven that? Is it the cost to income ratio?
That's been a key driver of that. So that's been a strong driver, and then also to a large extent, relative to peers, they've had a reasonably lower impairment ratio as well. So they clearly have been able to lend to better quality names, and then to a large extent as well, they've been able to manage their margins. So they've had access to low-cost deposits relative to the size of their branches, and because of that, you've seen net interest margins stay well ahead of the average. And then if you look at GTB asset quality is clearly a key differentiator. So I'd say over the last 10 years, through the last banking crisis, they've been able to maintain the lowest NPL ratio, lowest cost of risk as well. So if you compare their impairments to peers, it's been the lowest, and they've been able to manage that consistently. Asset capital adequacy ratio as well. They've still been able to maintain a decent capital adequacy ratio ahead of the regulatory minimum, even though because of the rapid depreciation in the currency and their foreign currency loans exposure, you've seen capital adequacy ratio come, the margins, or should I say the gap between the regulatory minimum, it's closed up decently.
The likes of Axis Bank, that's one I'm always curious about. Where do they stand in the cycle?
So I'll say within our coverage, so the top two within our top two preferred are Zenith, GTB,
right,
and then Access, UBA come in the next bracket, because they're banks that so far they've also delivered good ROEs, but I'd say it seems investors are still watching the asset quality. So if you look at NPL ratios relative to where the industry is, those two are around 2%. Industry ratio right now is around 11%. And so there's still worries about potential deterioration in the future, and how that would affect returns going forward. And also, if you look at those two banks as well, historically, investors have had not too good experiences. And so it's still taking a while for investors to completely trust such names, and you're seeing that in valuations as well. So those two are still trading at around 0.3 times book value, while Zenith is at 0.7, GTB over book value.
Perfect. Let's leave it there. Thanks to my guest, Muyiwa Oni, banking analyst at Stanbic IBTC.
Thank you for having me.
Thank you. That's all from Buy Africa this week. Remember to follow me on Twitter. That's at Modiba_Tshepho. And send us your thoughts about the show using the hashtag Buy Africa. From myself and the team,